Welcome to Portfolio Playbook. This is Damanick Dantes, and here's what came across our desk this week. First, the copper to gold ratio, which many investors are treating as an economic warning signal, is bottoming out. But this time, instead of flashing recession, the stock market has shown remarkable resilience. We're also watching the silver to copper ratio, which is surging as silver benefits from both its industrial demand and some of its financial attributes. It's a reminder that we don't fall into these narrative traps. You see, cross-market signals can shift their meaning depending on the macro backdrop. And while some of these correlations might hold over time, their lead or lag relationship can vary significantly. Next up, from our partners at Deep Macro, they still recommend a slightly higher than anticipated U.S. interest rate environment, which means slightly negative positioning on U.S. bonds, and that's ahead of the FOMC decision coming up, given that the market has likely gotten a little bit too ahead of itself on growth and inflation expectations. On FX, they're running a small net short on the dollar. That's tactical, very short term, highlighting just how much position is in relative value mode. Also, we noticed that history tells us that in the 12 months after the Fed starts cutting rates, that's after their first rate cut, short and intermediate duration treasuries tend to outperform long duration bonds. That's contrary to what many might expect and has actually played out this cycle. And that's thanks to curve steepening. But long duration also still plays a critical role as a hedge in your portfolio if the economy slides into harder landing than expected. You'll notice from our previous podcast episodes, we definitely are positioned and prefer the belly, the middle of the treasury yield curve. And now with long duration providing somewhat of a ballast, if we go into an economic contraction, we are monitoring some of those slowdown signals. For example, some of our research partners have shown the economic cycle has shifted into a slight contractionary zone. And if you look at the Conference Board leading economic indicators, the 6-month change has shifted back into recession mode, but it's been oscillating around that point for some time. While we don't position on the actual signal, we position on signs of a trough. So looking at the momentum or the change in those indicators, similar to what occurred at the end of 2022. Rather than starting at the top, when things get a little bit more stretched, we're looking for a bottoming out of those signals. And a lot of times the market leads the economy. And finally, from Morningstar, their research makes the case for active management in bonds. The bond market's inefficiencies and indexing challenges mean skilled managers often stand a better chance of adding value versus passive managers. And that's a stark contrast with equities, where active managers rarely win over the long run. So quite a bit to digest from the New York base, and now we'll shift gears to Asia. Chinese equities have been an important driver in global emerging markets lately, and especially in our portfolio, and our Asia correspondent, Elena Zeng, has been tracking the latest developments. Elena, what are you seeing?
Thanks, Damanick. Reporting from Shanghai today, and we have interesting developments to unpack. In the past few months, we have seen Hong Kong stocks bounce back with strong momentum, moving closer to their long-term averages after being deeply oversold. Mainland markets, meanwhile, are still a bit softer. They're trading slightly below their long-term average and carrying lower momentum scores, but that gap between onshore and offshore is starting to close. When we compare China to broader emerging markets, the relative price ratio is showing high momentum, though it is still below its long-term average. That tells us there's some catch-up potential. On the flip side, the copper to gold ratio, which we use to measure risk on versus risk off conditions, is still weak. And historically, that needs to turn before we see a more durable risk on backdrop linked to China's credit cycle. So what is fueling this rally so far? A mix of domestic liquidity, record levels of share buybacks, and renewed foreign inflows as investors rotate out of stretched US valuations. Retail money is also in play, with trillions of yuan shifting out of deposits and bonds into equities. All of this makes this rally look a bit more durable than the short-lived bursts we saw in 2015 or 2022. Both of those past rallies share some common traits. They were heavily retail-driven, without institutional or policy support, which made them vulnerable to sharp reversals once momentum faded. In 2015, The surge was powered by a margin lending boom and retail speculation. Growth was already slowing, but liquidity and leverage drove valuations to unsustainable levels. With limited institutional participation, the market overheated quickly and eventually collapsed in mid-2015, triggering a massive correction. In 2022, the rally came from reopening hopes after zero COVID and expectations of policy stimulus, but the economy was weighed down by property slump and weak consumption. The rally wasn't backed by earnings growth or structural reforms, and again, it was mostly retail-driven. Once reopening momentum disappointed, the rebound proved short-lived. By contrast, the rally we're seeing in 2025 looks very different. There's been broader institutional participation and sector rotation across areas like tech, healthcare, and consumer staples. That combination makes the current upswing look more sustainable compared to the bubbles of the past. That said, China is still a boom and bust market. Based on our framework, I suggest exposure here to be tactical. Best time with periods of dollar weakness and positive growth surprises. Remember, for us, emerging markets aren't part of the portfolio's core. That role belongs to more consistent trends in developed markets like the US, but we do have a slight tilt to EM, especially China, and that has been a meaningful source of outperformance versus the benchmark recently. So the question now is whether momentum can turn into something longer lasting. For now, we're participating in the recovery so long as our relative strength signals remain positive. The good thing about relative strength is that we can tilt away from Chinese equities and into other areas of emerging strengths once price trends mature. We avoid forecasting, instead we avoid laggers and adapt to new opportunities that meet our criteria. Back to you, Damanick.
Thanks, Elena. All great points. I want to revisit the copper to gold ratio. I have a chart here going back to 2000, and recently we actually show a breakdown in the ratio below its 2019 lows. And back in 2019, of course, that low preceded the strong rebound that we saw in the copper to gold ratio and equity markets after the COVID induced slowdown. And what's interesting is that if you go back and you'll see the divergence now, or the narrowing between the Shanghai Composite Index and the copper to gold ratio is pretty significant. To see something similar, we'll have to go back to the end of the financial crisis. Shifting forward a few years, back in like maybe 2014, there was a slight advance in the Shanghai Composite ratio and a continued decline in the copper to gold ratio before both indicators actually shifted higher. So there tends to be this lead lag that's been expanding over time. So it's not necessarily a timely signal in capturing a low in the copper to gold ratio and then signaling a sustained rally in equities. And from a macro standpoint, you'll find that the boom bust scenarios in Chinese equities has actually become a bit more muted after 2018 or so. And that's because, previously, a lot of these rallies have been stimulus driven or an artificial boom scenario, whereas now it's up to the real economy to show its full colors. And hopefully that might, induce muted volatility, but a more sustained rally in emerging markets. But as you say, the trend is not sustainable over the long term enough for us to build a core position there. So emerging market equities, like international equities overall, maintain tactical weights in our portfolio while we shift to US and more developed markets as the portfolio's core. That's all for now. Thank you so much, Elena, for joining the show, and we'll speak to everyone else soon. Take care.